The first real hint of a slowdown in interest rate hikes. I'm Scott Inman with this week's fastest 4 minutes in finance. Well, as expected, the Federal Reserve announced Wednesday a 0.25% increase in the federal funds rate, taking the short-term borrowing rate to a range of between 4.5% and 4.75%. But it was the implied shift in future decisions about interest rates that sent the market soaring after the announcement. The Fed announcement was much the same as it was December 14th, but with a few bits of softer language. Back in December, the Fed referred to the future decisions about the target range of interest rates and inflation by saying, quote, determining the pace of future increases in the target range. Well, this week, the statement read, quote, determining the extent of future increases in the target range. Now, there was some other language in there, but that one word made it seem that the Fed is now considering when to stop interest rates rather than how fast to raise them. Chairman Jerome Powell made it clear that the rate increases were not over yet, but made references to inflation cooling, which is the headline reason for the rate hikes. LPL chief economist Jeffrey Roach told us last month that in his view, the one thing that could be the catalyst for a better year in the stock market was the Fed indicating that the battle with inflation is being won. Well, Powell didn't exactly say that, but he did indicate that we are making progress, and that was enough for investors who have been looking for any good news to propel stocks higher. The S&P 500 was up more than 5% in January, and historically speaking, that's a very good sign for the rest of the year. According to Carson Investment Research, if January is positive, the rest of the year is higher 86% of the time, and the average is 11.9%. If January is up more than 5%, the rest of the year is up 85.7% of the time and up on average 14.2%. And here's one more for you. If the previous year was negative and January is up more than 5%, the full year has finished higher every time. It's happened 5 times. The average gains are close to 30%. So the table is set for history to repeat itself if inflation continues to cool and interest rate hikes come to a close before the economy slows down too quickly. So the soft landing is still on the table, but most economists still believe the United States will enter recession in 2023, but that it will be mild. The Fed's move and comments that followed did little to change the immediate trajectory of the economy, but it did seem to give investors a promise that better days are ahead. Bottom line here for us, stick to your plan and remember that things are never as good or as bad as they seem. Stocks may soar for a little while with good news, with the hope of a soft landing out there, but you should expect more volatility ahead, and there may even be another significant pullback. Your plan should expect all of that. If you don't have a plan, a genwealth advisor is here and ready to help you create one. Thanks for listening.